of the minutes. Do I have a motion?
Move to approve.
Second.
All those in favor signify by saying aye.
Aye.
All opposed, same sign. Motion carries. Okay, the next thing up is the Capital Cities presentation. Go ahead, Amanda.
Good evening, everyone. My name's Amanda Black with Capital Cities. I'm part of the firm that serves as your co-fiduciary of these assets. So today, I've got a relatively brief agenda. I'm going to cover the third quarter report, and I'll give you updated results even here through November. I'm going to do a little bit of a discussion about the spending policy, and then I'm going to leave you with your updated investment policy statement. Any questions? Okay, so let's first dig into the third quarter report. I'm going to start on page 1, where it says market overview at the top. I would just like to give you a brief synopsis of what was happening in the markets in the third quarter before I talk about your portfolio specifically. So in the third quarter ending September 30th, the biggest story once again was the Fed. The Fed here in the U.S. cut interest rates twice, and then again they cut rates after the third quarter in October. So while those interest rate cuts were accommodative to the markets, they also signaled that there were some concerns about slowing economic times ahead. So in that type of environment, we saw a little bit of a different performance pattern in terms of what was doing well and what wasn't in the markets. So if you look there in the middle of the page, what you see there, those blue bars are equity returns for the quarter, and then, the gray bars are the returns for the year. So this was one of those types of market environments where it actually paid to be in safer kind of U.S. large cap stocks. So the S&P 500, which is denoted there by the large cap core bar, was the best performing area of the stock market for the quarter. Other areas of the stock market, like smaller company stocks and non-U.S. markets, did not do as well. Over the last 1 year time period, we're still seeing that kind of diversion in returns, again, where large cap stocks in the U.S. are doing well, but smaller cap stocks and non-U.S. stocks are not performing as well. Non-U.S. stocks are also faced with some of the concerns about trade negotiations and Brexit and things like that. So a little bit of a mixed bag for equity market returns. But your portfolio certainly benefited from having a significant large cap exposure, so I'll get to that in a second. Now, looking at the bottom of the page, what we really saw that was quite unusual were these outsized fixed income returns for the quarter and really for the year. So with the Fed cutting interest rates, that sent bond prices higher, which really was positive for fixed income returns. With your portfolio being 60% fixed income, you really benefited from this. So then if you look on the next page, we'll go through this whole page 2, starting at the top, to give you a snapshot of really all of the key things that you as fiduciaries ought to be looking at with this portfolio. So at the top, you see your actual allocation on the left at the end of the quarter. You see every one of your underlying investments where the blue pie slices are equity, the green are fixed income, the gray is cash. You ended the quarter with 39% of your portfolio in equities and 61% in fixed income, and that was really right in line with your strategic allocation of 40% and 60%, which is outlined in your investment policy statement. In the middle of the page, you see your market values. You ended the quarter at $166,648,270, and that represented a return, an investment return of 0.9%, so just shy of 1%, so 90 basis points return for the quarter, bringing your last 12 months return to 4.9%. So keep in mind that that last 12 months return still incorporates that fourth quarter of 18 that was quite difficult. So just to remind you, in the fourth quarter, the portfolio was down 5% in the fourth quarter. So that positive 4.9, again, includes that. So even with that, we're seeing really positive returns. There are no changes to your stoplight grid at the bottom, so no concerns with your managers at all. So I want to touch on performance a little bit more in detail, and then what I'll do is update you on more specific numbers that I have as of Friday. So if you would, please look at page 4, and I'll go into a little bit more detail. So when we look at your returns, I'm looking at the middle chart on page 4, or it's kind of the top chart on page 4. I want to show you your year-to-date return. So it says Porter, or P-O-R-T, total portfolio, letter A, in the table, your year-to-date return. So January 1st of 19 through September 30th is 10.7%. So really outstanding performance so far in 2019. Well ahead of your performance target where you're trying to seek 5% per year. Yes?
What is that in?
In dollars? In dollars, that is
A lot.
16 million or so.
That's all.
That's no drop in a bucket, yep.
No.
16. So, and I'll actually give you some hard dollar figures in a second. I don't have that specific one, but I've got some others
Thank you.
that I think you'll be interested in. I want you to take this, look at this chart all the way to the far right, that since inception. So now we're going on more than 3 years of actual history of this foundation being invested. The average annual return since that time, since April 1st of 16, the average annual return has been 6.58%. That number is exceeding, just barely, the manager benchmark, but it's strongly exceeding your performance target of earning 5% a year. Now I want to give you a couple updates on current figures. So first I want to give you the market value of the portfolio as of November 15th. So as of November 15th, the market value is $170,272,861. So that represents another 2.2% return since the end of September. So from October 1st through November 15th, those 45 days or so, we earned another 2.2%. So now that brings our year-to-date return to 13.1%. And then the one I really want to touch on is the inception-to-date return. Excuse me. The inception-to-date, so from April 1st of 16 through November 15th of this year, you've experienced a 7.04% average annual return. So now, if you would, turn to page 6. Now this page, keep in mind, because this is the formal report, it's as of September 30th, but you can kind of add a little bit to these numbers. So we've now reached a 25% cumulative return on these assets, and at the bottom, that corresponds to a $33.7 million gain in assets in the portfolio. So theoretically, that's probably closer to $35 million. So $35 million in gains since this has been invested on April 1st of 16. So just really happy to give you that update, especially after experiencing a difficult 2018. Now I can't guarantee you that these numbers will be locked in for the next 45 days, but we'll keep our fingers crossed on that. What's that?
And we're going to talk about how to mitigate that in a minute.
Yep. So any questions on performance?
We steered some of that money away from the international equities.
Are we steering some of it away? Well, right now, you have a strategic asset allocation that, bear with me a second, I'll give you the exact number. I'm sorry. So you have a specific, I'm sorry, right there. It's on page 2. A 10% allocation to international equity. It's not our decision as your advisor to tactically allocate to that or away from that. You have a strategic asset allocation that the group came to a consensus on, which is outlined in your policy. So with that said, the idea is to keep that intact for a longer time view, and the way to change that would be to do so during an asset allocation discussion, which we do each year. So we're certainly happy to look at that if that's the kind of group's consensus. But until then, that would stay put.
Did we do that last year right at the beginning of the year? Is that when we normally do
We
that?
actually did it last quarter.
Last
Yeah.
quarter,
Yep.
okay.
Now, we talked about it a little bit. With that said, 10% to international equity is quite low relative to other foundation peers. Not to say that you should follow your peers exactly, but a market-neutral allocation would be about almost 50-50, U.S., non-U.S., meaning if you take all the stocks that are there in the world and you just replicated that in your own portfolio, it would be about 50-50. Most foundations in the U.S. do have a home country bias, meaning they have more in the U.S. than non-U.S., but I would say most foundations have between 25 and 40% non-U.S., so you with 10% are quite below that. So I think it displays kind of your conservatism, but still gives you some diversification.
And that's been the poorest performing market, correct?
It has been. It has been but it's been for a 3-year time frame, which we still view to be quite short in the whole scheme of things.
Okay, thank you.
Thank you. Okay. Are we ready to move to the spending discussion? It's a separate handout in the back pocket of your portfolio, of the folder. So just to remind everyone, we did a deeper dive on the asset allocation of the portfolio at the last meeting, and one of the takeaways of that was that we wanted to further discuss the spending policy that's utilized to determine how much of these assets can be utilized in the community and in the county. So I want to just make sure, first of all, on page 2, that we're all on the same page, understanding kind of what the policy says and how it's utilized. It's really important to remember that this foundation was established through the legislative code, so Indiana Code 36-1-14-3. So that legislation allowed the county to create a foundation that could invest in assets out of short-term fixed income. And that's really what's led to that, $35 million in gains. The Indiana Code also establishes the spending policy. That is how this group can determine how funds are utilized. So now, here we are with 3 years of experience kind of under our belts with this foundation. And I think it's lending itself to digging into this policy a little bit more, because now that we've seen it working, we realize that there are some nuances of it that might be improved if you so desire. So I want to kind of explain what that all means. So we've got the exact language in the gray box there, so you can kind of read that on your own. The lens that I'm going to take in looking at this is not a critical one, it's just a comparative one. I want to talk about how this policy reads relative to how the policies of other foundations read. And we can kind of discuss the pros and cons. So it basically says that the foundation can transfer up to 5% of earnings per year, and that the extent that income earned on money in the fund exceeds 5%, then the excess income can be added back to the principal of the fund. So at the very beginning of all of this, when we were all working together to set up the asset allocation and all of the, the risk tolerance, all those things we were talking about, we also worked together to come up with a practical way to interpret this so that we could be ensured that each year, no matter what, we were going to use the same interpretation. So we had help with various people sitting here, attorneys and all of that, and the practical application and assumptions are listed here in the middle. So first of all, the policy talks about investment income. The first interpretation we made was that we'll use total return. So investment income and total return may or may not be the exact same thing, but we felt like the spirit of the language was to be looking at total return. So total return performance is everything that I was just telling you about, the 6.98% since inception. So first of all, we use total return performance. Each year, on December 31st, we look at what that number is, and if it's higher than 5%, then that would suggest that this group can determine how much of that, up to 5%, can be utilized for spending. Well, the way you arrive at what that dollar amount is is you take that percentage, let's call it 5, you multiply it by the market value at the beginning of that calendar year, but that market value at the beginning of the calendar year has the payout from the previous year in it, so you have to subtract that. So that's the practical application of how you come up with the number. And it was really important to everyone, again, that we just do the same thing every year. So that's the interpretation. Now, some of the nuances of this, if performance is below 5%, here we say, for example, 3, then only up to 3% can be used in your calculation. If performance for the calendar year is negative, like what we experienced in 2018, then 0 spending can occur. Any questions so far? I know this is a lot of
Yeah, we knew this part.
Okay. I just want to make sure it's clear.
That's all.
Now, some considerations at the bottom that I want to talk about. The fact that you're basing your spending on a single day's return and a single day's market value leads to potentially high variability. So you could be going into December 31st with, sitting at a 7% return, and the market could drop overnight and you could spend nothing. And you would not have known that. So it would be a shock to the budget. So that type of variability is difficult for foundations who are being counted on in the community. So because of this, spending policies of foundations, so other foundations typically utilize a rolling average of ending market values. So for instance, you would use a 20-quarter rolling average, so that when you are getting close to that December 31st period, you will know 19 of the 20 numbers making up your average, so that you're really not going to have any surprises drastically in what your spending amount will be. You also would just use the ending market value so that you're not having to go back and adjust anything for previous periods. The other thing we would just suggest is that you, change the term investment income to more of a total return number. That's more industry standard. Does all that make sense? That's all the theory.
Can we talk about 2018 real quick, just
Sure.
to bring that home? It was the last quarter that really did us in.
Yeah.
Right? So even just for that 1 year, we had 3 positive quarters that would have gone into the average.
Correct. Yes, because all of 2018 as a whole, I don't have the exact numbers, but the 2018 as a whole, your return was negative 2.9, but the fourth quarter was negative 5.2. So you were considerably positive going into the fourth quarter. Let's look at the next page. Here I just want to quickly tell you what other foundations typically do. So there are 4 on here, but really there are 2 main spending policy types utilized out there across the country with other foundations. One is determine an amount, a dollar amount, and then adjust it for inflation every year. And then no matter what your market value of your portfolio is doing, you're still just spending an amount based on inflation. So if it's $2 million a year, you would apply a 2% inflation number to it every year, and you would just know that's what we're going to be spending, and we're going to try to create a portfolio that can support that. The most commonly used type of spending policy is the percentage of a portfolio, and that's really what yours is trying to do. Yours just has those nuances. So 84% of public foundations like you across the country use a percentage of a portfolio. The vast majority, if not all of them, use a moving average of some sort, whether it's 3 years, whether it's 5 years, whether it's even just 4 quarters. That's better than just one single day. So that's definitely the common approach. And then the average spending rate is about 4.6%. So I think that it probably goes without saying, but the point of using that smooth market value is not just to limit the variability, it's also to keep you from spending too much when you're doing great, and it's to allow you to still spend money in the off years. So in 2018, you would have still been able to spend something, so to speak, but it would have been certainly less, but it would keep you more stable along the way. And I've got a couple charts to kind of show you what we mean by that. Now, on the next couple pages, I want to, the word example or sample should be stamped across all these pages. So what we did is we did take your market values that are legitimate market values, but to go back further in history, we said that your original market value persisted back into history. We also said that your ending market value goes forward. So we created more data than you actually have, just to be able to show you some charts. So what we have here, we have 4 different types of spending. So what you're looking at here are dollar amounts spent. None of these are what you actually spent. So the solid blue line is if you were just picking a number based on the December 31st value. But the blue line allows you to still spend even if you had a negative year. The dashed blue line shows a rolling 4-quarter average, and then the green is a rolling 12-quarter or 3-year, and the yellow is a rolling 20 or 5-year. The whole point of showing you this is just that by using a smooth approach, you can have much more consistency, and it actually should lead to higher growth of assets over time, again, because you're preserving assets by not spending too much when times are good, but you're still allowing some spending when times are bad. Now, on page 5, we put in your actual spending with the orange. We didn't put it on the previous page because the scale becomes a little difficult to kind of see. So this just shows you, with your methodology, which it's not a criticism, there's so much variability just in the way your calculation is defined. So we would, I know that it requires likely legislative action, so that's outside of my purview, but we would suggest that you consider utilizing some type of spending policy that utilizes smoothing in the way that you're calculating it. So that's kind of the extent of what I wanted to present. I definitely want to leave time for discussion. This is kind of more theoretical, so happy to answer any questions or.
Well, I think it's clear that the smoothing approach makes a lot more sense, and I think we're all in agreement.
Not necessarily.
Or maybe.
We're not all in agreement.
Many of us may be in agreement on that. So I guess if that's the case, the next question would be, if that's ultimately what we want to do, what would be the appropriate next steps to get it done?
Scott, does that require some law change?
It does.
There you go.
So how would we move forward from this point then?
Maybe a resolution to take forward to our legislators?
Yeah.
What are the concerns? Maybe now's a good time to get some questions answered while Amanda's here.
Well, being that we know what it felt like with that 2018 drop, we want, it would be...
Well, if it happened again this year, we would...
Yeah, we'd be, so I think that we should move to make it a little bit smoother.
My question is, how many other organizations use this formula, and do their principals keep generating income? I mean, to the point where they're not touching any of that. Are all of them secured like we are?
Oh, okay, so, and that's where it gets a little tricky, because it's not, if you were just generating income and then cutting a check, with the income, like if you're clipping coupon payments and dividends, that's really, not many foundations utilize an income approach anymore. Your dividends and coupon payments on your bonds are reinvested every day by your managers, so that really you're targeting total return. So that's what complicates that a little bit. There are still some foundations out there who use an income-only approach, and every single month they're getting a check or cash into their account that's dividends and interest, and then they only spend that. But this portfolio is not set up to be high income generating. I mean, it certainly generates some, but that would require a different investment approach where you'd be targeting like higher yielding bonds and things like that. So I don't know if that answers the question.
I think my question is if we consider smoothing, as many organizations have chosen that route, is there a negative impact to the funding that's going on in that?
There has to be.
If you have a negative return and you still want to spend X amount of dollars, you're going to have to dip in the principal.
Right, but what I'm saying is so they're taking 20 quarters. What is it at 48 quarters or 60 quarters?
Well, either way, if you go with the smoothing approach, if you have a negative return one year and still want to spend X, you have to dip into the principal.
Not necessarily if you
No.
build up returns in the previous.
I guess for that year, it would
Well-
be principal, but you would also.
Well, I mean, when I say
more
the principal, I mean I'm talking about the pot of money.
Right, the way it's.
You're going to have to dip into that.
Yeah, but it goes both ways.
Mm-hmm. I know.
I guess I would like to ask Matt or Mark if they have a professional opinion or feeling on
Oh, here
this
it comes.
particular topic.
Personally, I just look at my own parents, right? So they have a portfolio, they have the need for X amount of dollars every year. And regardless of what happens in the market, my parents have to take out X amount to live. That being said, I think the question is, where do we need the money? And have we allotted this money year after year after year so people are expecting it, and therefore we have to spend it? I think that's more the key. And I think it's great to have the smoothing where you can be consistent. I think that's the best approach, but at the same time, if we don't need to spend the money, we actually don't need it, and no one's counting on it, then that's my own personal
But
feeling.
right now, we are counting on it in our
Right.
budget.
Well, and that's where
Yeah.
I lack that knowledge, but that's my 2 cents.
I might have 2 cents. No, I think that Amanda's done a nice job of presenting this, and I think the reason that most vast majority of foundations choose to go this route is it's more dependable, reliable, less volatility, and you've got to keep in mind the horizon. This is a long-term investment horizon. We're in the very early stages of it, so anything that we see is kind of magnified today. But if we think about this as a perpetual or forever investment that will be here forever, the lack of volatility is important. There may be times where there's a dip, but there's likely to be more times where there's not. And I think it makes a lot of sense, and I know there'd be a lot of work involved with it. It's not just a decision we can make, but it does make a lot of sense to me to smooth that out.
Thanks. Does anybody else have questions down there?
Not at this point.
Amanda, would this change our fiduciary responsibility or our contract with your firm?
No, not at all.
Okay, just wanted to cover that.
And we can work in any situation
Okay.
here. We were asked to just provide some thoughts on what are other foundations doing, what are best practices, where have things moved, and what are the pros and cons.
I just didn't want to
Yep.
have the oh, but later.
No,
That's
no
all.
worries.
So do we want to work on a resolution before the next meeting? Are there any huge hesitations here?
I'm not ready, if you're suggesting tonight, I'm not ready. But if
No,
you're
no,
suggesting
before
for our
the
next
next
meeting, yeah, I think, because, I'm not necessarily opposed to the idea. We've got the information, and there are some questions I have, but I'm not ready to ask them tonight, and they're not necessarily questions of Amanda, frankly. But I would like to have an opportunity to do that. But, yeah, I think we should, look at this at our next meeting and maybe
I
talk
agree.
amongst ourselves.
Okay.
Do you have a recommendation on the quarters, amount of quarters to go with? Is there a standard, an industry standard?
I think for new foundations, 20-quarter is kind of what people are moving to. But if you were already established with a 12-quarter, I wouldn't be beating the table to change it. So the way you do that, even if you don't have 5 years or 20 quarters of data, you would just write it so that 20 quarters or every quarter that you have until you get to that point. I'm sure there's a better way to say that, but that's the typical way.
Thank you.
Anybody else have anything to add? Thank you, Amanda.
Okay, one more thing, I'm not going to cover it. There's, every year we look at your investment policy statement and we determine whether it needs any updates that we think need your attention. Of course, the policy always needs your attention, but this time around, we've only made very minor tweaks in the appendix. Like, for instance, we updated the market value to be more current, and then we pasted in the slide from the asset allocation study that gives an updated risk and return figure All of those are, again, are in the appendix. There's a red line and a clean version for you to look at. It does not require a new signature because of those types of edits, but as always, please take a look, and you can always let us know if you see anything else or any other questions. So just wanted to leave those with you.
Pardon me, what was the slide that you inserted, you said?
It's the pie chart picture that says,
17, page 17?
yes, I think so.
This one here?
Yes. So that was just outdated. The number in the call-out box at the bottom was what was outdated, the updated risk and return using updated capital markets expectations. So we view those as housekeeping changes. Okay?
Before you leave, we should try to set our next meeting. That would be in February.
Or March. Or March.
Or March.
Well, I'm only question, it doesn't make a difference to me. It's just that if we go in March, it'll give us more, should be able to give us kind of an up-to-date hit on what we're doing. Unless it's bad news, then it's better if we do it like in January or February.
I'm out of town on the 25th of February.
I think, when does the session start, middle of January?
Yeah, I'd like to
Right,
meet
usually, right in
earlier in the
here.
year.
Mm-hmm.
March is also spring break and probably Easter. When do you guys have a meeting, the 25th of February?
25th of February is our
Too
council
late.
meeting.
But man, you said you were not available.
I have to attend a different
You said you're not
client
available.
meeting out of state.
I'm sorry, I thought you said March 25th.
I mean, we have others that could attend, so
Doesn't have to be you.
it doesn't have to be me.
Of January.
Do you want to try for the January 28th meeting?
Yes.
Do you guys have a 28th meeting in January, Dan? That's the fourth Tuesday of January.
Yes.
Would that?
Maybe. We have to talk about that. Yes, but since we're probably not having a meeting in December, we may have to push our January meeting up.
Oh,
Well, let's tentatively schedule it for that day, and then we'll see if you guys move it, or...
Which day?
January?
That works.
In January?
That is,
January
we
28th.
wouldn't be able to do our full report.
Oh, okay.
We won't have all of
But
the
we know.
group data.
When,
Too early.
You'd have the summary.
We could do a summary, which is fine. So let's keep it
we'll
tentative.
start there. and-
Want more
Okay.
information?
Yeah, January 28th.
Okay.
Foundation meeting.
Yeah.
What?
That seems awful early.
Trying to get in.
Well, if we decide to do smoothing,
Oh,
we want
because
to
you're
hit
thinking of
that
the legislative
legislative.
session.
I don't think it'll get through this session anyway. They ain't gonna move that fast.
We should
What's
start
that?
it though.
I don't know if we could get something through this session this time around anyway. Just too quick.
Well, we should try.
All right.
Don't move that fast.
Got it.
Thank you.
Thank you.
Yeah, thank you, ma'am.
Thank you.
Have a good evening.
I understand there might not be a council
Sure
meeting that
thing.
night. Y'all understand that, right?
We may have, this is tentative.
All right. Well, I understand, but I'm just telling my council members that we might not have a meeting that night.
Real quick, I forgot to do roll call at the beginning.
Now they get to go.
Now everybody's here. We do roll call real quick before we dismiss.
Okay, let's do roll call.
Okay, something's wrong. Yeah.
Commissioner
We got something.
Blaney,
Present.
Commissioner Good,
Here.
Commissioner Biggs,
Here.
Councilmember Witten,
I'm here.
Councilmember Graham,
Here.
Councilmember Jessen.
Here.
Councilmember Larson.
Here.
Councilmember Paparad.
Here.
Councilmember Reed.
Councilmember
Councilmember Sims. Advisory members, Mr. Vesely.
Here.
And Mr. Ritchie.
Here.
Any, thing from the attorney?
No.
All right, motion to adjourn?
So moved.
Did we already do the claim approval? Did we do that?
Oh, I'm sorry, I missed that. No, we did not.
Oh, awesome.
Thank you, Dan. I'm forgetting everything.
Maybe I missed it, sorry.
Amanda left.
Yeah.
Get paid. She didn't, she left.
Yeah, done,
All right.
fine.
That's not important.
We have a claim approval for the third quarter 2019
Motion to approve.
consulting fee.
Second.
All right. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. All right,
Is that it? Yep.
meeting's adjourned.
Awesome, thank you.
Yep.
Take a short break.